All right, welcome back. Let's just jump right into it because what we've seen in the global financial markets over the last few days has been, well, completely nuts. We are talking about some of the wildest, most unpredictable swings, especially if you've been keeping an eye on gold and silver.
Honestly, thrilling might be an understatement. I mean, think about it. In just 3 days, we saw gold and silver prices absolutely rocket up, like nearly 10%. But then, before you could even catch your breath, they came crashing right back down again. If you've got any skin in the game, it's been a real heartstopper for sure.
Now look, if you think this is just about gold and silver acting weird, you're missing the forest for the trees. This volatility, it's not random. It's a symptom. It's a massive, blinking red light telling us that the entire global market is sitting on a knife's edge. Why? Because there are two enormous time bombs just ticking away, and they're both set to go off this February.
Okay, let's try to defuse this first bomb. And it's all about a potential new leader at the U.S. Federal Reserve. Now, to really get why this is such a big deal, we gotta hop in a time machine and go way back.
So picture it, the year is 1979. Inflation in the U.S. is just completely out of control, spiraling into the double digits. President Carter brings in a new Fed chair, Paul Volcker. And his solution? It was absolutely radical. He jacked up interest rates to an unthinkable 20%. The result was a shock to the system. Yeah, inflation got crushed, but the economy took a massive hit in the short term. And the market reaction? Whoa. Gold absolutely collapsed, down over 70%, while the stock market, after some early pain, kicked off an incredible 18-year bull run. This just goes to show you how one person in that chair can literally reset the entire market for a generation.
Okay, now let's zap back to today. And the parallels to 1979, they are pretty uncanny. President Trump has been very clear he's not happy with the current Fed leadership, and he could nominate his very own hawk, a guy named Kevin Warsh. And this possibility has the entire market asking a multi-trillion-dollar question. Are we about to see history repeat itself?
So who is this Kevin Warsh guy? Well, he's a former Fed governor, he's got deep roots on Wall Street, but what really matters is his policy stance. He's a big believer in preemptive rate hikes, basically fighting inflation before it even shows up. He is without a doubt the most hawkish candidate you could possibly imagine. He's a true strong dollar guy, and you better believe the market is already starting to price in this possibility.
And that is our first time bomb. This expectation of a much more aggressive Fed is causing the US dollar index to get stronger and stronger, with traders eyeing that 103 level as a big target. And as you know, when the dollar gets stronger, assets priced in dollars like gold get pushed down. This is a huge piece of the puzzle for why we saw that recent drop.
But hold on, a hawkish Fed isn't the only thing we need to worry about. The second bomb is ticking away in the Middle East, and frankly, its blast radius could be even wider. We're now shifting gears from monetary policy to pure high-stakes geopolitics. Yep, we're talking about Iran.
And history gives us a pretty ironclad rule on this one. When a major conflict blows up in the Middle East, markets react in a very predictable way. Just look at the data. The Yom Kippur War, the Gulf War, the Iraq War. Every single time, what happens? Oil prices go through the roof, stock markets tank, and investors scramble for safe haven assets. It's one of the most reliable patterns in finance.
So, why are we laser-focused on Iran right now? Because the military buildup in the region is undeniable, and it's happening fast. We're not talking about symbolic moves here. The USS Abraham Lincoln Carrier Strike Group is in position. We've got advanced fighter jets, drones, missile defense systems all being activated. The U.S. Air Force is even openly calling them readiness drills. This is serious.
And here's the crucial point. February really looks like a critical window. You've got the political will, the military hardware, and the strategic timing all starting to line up. So this isn't just posturing anymore. The chance of real, actual military action is now incredibly high. The big question on everyone's mind is this just a bluff?
Okay, so we've got these two incredibly powerful forces just set to collide this February. A huge monetary policy shift on one hand and a massive geopolitical crisis on the other. So how in the world do these contradictory forces actually play out? Let's try and break it down.
For anyone invested in gold, this is the ultimate tug-of-war. Bomb number one, that hawkish Fed, is bearish. It's pulling prices down as the dollar gets stronger. But bomb number two, the risk of war, is massively bullish, driving a huge flight to safety. The outcome here depends entirely on which bomb explodes first, or what happens if they both go off at the same time.
Now for U.S. stocks, the picture's a little bit clearer, and frankly, it's leaning bearish for February. If that strong dollar, hawkish Fed story really takes hold, we could see a pretty serious correction. I'm talking a potential 10 to 15% drop from the recent highs.
So, for gold and silver, what's the forecast? I think it's volatile consolidation. That sharp drop we just saw, that was probably just clearing out the weak hands. But a major breakout to the upside seems unlikely until we get some clarity on the geopolitical front. So just expect a choppy, sideways market as these two forces battle it out.
This whole situation creates a unique condition, and it's called asymmetric risk. It's when the two main drivers are pulling in completely opposite directions. And it is a textbook recipe for extreme volatility. You know, in a full-blown conflict, we could even see something really rare happen, where both the US dollar and gold rise at the same time, as global money just panics and rushes into the two biggest safe havens.
So with all this potential chaos, what's the ultimate takeaway? I mean, how do you actually play this? How do you navigate a month like February?
Okay, the goal for February is simple. It is not about making fast money, it's about defense. It's about preserving your capital. It is about avoiding that black swan event that could just wipe you out. Either of these bombs could detonate without any warning, and this is a time for caution, not a time to be a hero.
And this brings us right back to where we started. I really want you to remember that story from 1979. At the time, what Paul Volcker did felt like an absolute catastrophe. The market was in a total panic. But looking back, that moment of maximum pain was the necessary turning point. It was the setup for one of the greatest bull markets in all of history.
So, the path forward is actually pretty clear. Step 1, acknowledge these two very real, very present dangers. Step 2, make preserving your capital your number 1, 2, and 3 priority. Step 3, your only job right now is to survive the short-term volatility. And finally, Step 4, be prepared. Because if history is any guide at all, on the other side of all this chaos could lie a truly historic opportunity.
So that leaves us with the crucial question. Are we looking at a moment of maximum risk or a moment of maximum opportunity? And you know what? The answer is, it's probably both. Thanks for tuning in, and we'll see you next time.